So here is the second part of our partnership operation discussion. Now let's proceed to number 5. For number 5, salaries of 3,000 and 2,000 a month to Castro and Diaz respectively, provided annual earnings are sufficient to cover allowance. If earnings are insufficient, the profit shall be distributed in the salary ratio. If operation results in a loss, it shall be distributed equally. So, as what I have discussed in part 1, salaries are to be given regardless of whether there is profit or loss, unless there is a statement as to whether there are changes if ever the company incurred a loss. Now, for this problem, it is specifically stated that if the earnings are sufficient to cover the allowance, then they shall be given salaries of 3,000 and 2,000, and take note that is every month. But, however, if earnings are insufficient, then it shall be distributed according to the ratio of the salary, which is, as what you can see, the 3,000 and 2,000. And also, if operations result in a loss, it shall then be distributed equally. Now, class, let us first compute how much is the salary, or how much are the salaries of Castro and Diaz. So for Castro, that is 3,000, right? Okay, we have here for Castro salaries, that is 3,000 multiplied by 12, so that is 36,000. While for Diaz, okay, that is 2,000 multiplied by 12, so that is now 24,000. So if you're gonna add the two, okay, that is 60,000. But take note, class, that our profit here is only 23,800. So where does this situation belong? The first situation is if earnings are sufficient. The second is if earnings are insufficient. And the third one is if it results to a loss. Now, since we have a profit, so we have to choose from the first and the second situation. But since the salaries alone is already 60,000, but our profit is only 23,800, then our situation belongs to the second case. That is, if earnings are insufficient, the profit shall be distributed in the salary ratio. And so therefore, for Castro and Diaz, okay, we will have to change our solution. So we have here Castro and then Diaz. Now that is 23,800 multiplied by the ratio of their salaries. Now, as you can see, the salary is 3,000 for Castro and 3,000 for Diaz. So that means that the total is 5,000. So for Castro, the ratio is 3 over 5. Well, for Diaz, that is 23,800 multiplied by 2 over 5. So that is 2 over 5. That means 2,000 for Diaz, and then with a total of 5,000 for them too. Now, to compute for the salaries, we have 23,800 multiplied by 3 over 5 and 23,800 multiplied by 2 over 5. Okay, so this is now the distribution of our profit. Now we have 14 to 80 plus 9, 520. So that is a total of 23,800. Now class, if you notice, this only constitutes the salary. So this means that our whole or the whole amount of the profit is being allocated based on the based on the ratio of the salaries of Castro and Diaz. Okay, so this is the distribution. Now, class, how about if the partnership operations resulted to a loss? Okay, so let's say, for example, if it resulted to a loss, let's say, for example, if it resulted to a loss of 5,000 pesos, how are they going to distribute this one? So that belongs to case 3, right? So we have Castro and Diaz. Now in case 3, if ever that the partnership resulted to a loss, then they will have to distribute the loss equally. So that means it would be 2,500 loss, share the loss for Castro, and also 2,500 share of the loss by Diaz. So that is for a total loss of 5,000 pesos. Okay, take note, this is only an assumption if ever there is a loss on operations. Alright, so that would be for our first illustration. Now let's proceed to the next. Alright, so we still have illustration 2. Okay, so illustration 2. Alright, so the question is the share of PP and QQ in the 51,000 net income would be. Alright, how much is that? PP and QQ are partners operating a chain of retail stores. The partnership agreement provides for the following. For PP, we have salaries of 10,000, interest and average capital balances of 10,000, bonus of 20% of net income before interest but after bonus and salaries, and the remainder of 30%. For QQ, we have salaries of 5,000, interest and average capital balances of 10,000. QQ has no bonus, but the remainder is 70%. The income summary account for year 2011 shows a credit balance of 51,000 before any deduction. So what does it mean? This means that there is a profit, okay, because it shows a credit balance. Average capital balances of PP and QQ are 50,000 and 75,000 respectively. The share of PP and QQ in the 51,000 net income would be, alright, now let us compute for the allocation of net income. So we have for PP and for QQ. Now let's start with the first one, that is the salary. So accordingly, they are to be given 10,000 and 5,000 salary. So that is for a total of 15,000 pesos. Now next is, sorry. Next is the interest. So as you can see, we are to give them interest on average capital balances. Now accordingly, the average capital balances are 50,000 and 75,000. So in this case, it is already given. So 50,000 multiplied by 10% and 75,000 multiplied by 10%. Okay, so that is for a total of 7,500. Now next, for the bonus. So only PP is to be given a bonus. Now, accordingly, the bonus should be 20% of the net income before interest but after bonus and salary. So what does it mean? So when we say before interest, so that means that the net income shall not be deducted by the interest when we are to compute the bonus. So let's say, for example, we have here the net income of 51,000. So since that is before interest, so we don't have to deduct the interest. What are we gonna deduct here is the salaries. Okay? So less of the salaries because it is stated in the agreement. So the salaries or the total salaries is 15,000 pesos. Now take note plus that there may be times that the agreement will say that after salaries of PP only. So in that case, you are only to deduct 10,000 pesos. But in this problem, there's no statement as to which salary is to be deducted. So it only states generally that after bonus and salary, so that means it is the salary of them both. Okay? So the net income after salaries, but still before bonus, is 51,000 minus 15,000. Now, if you remember, if you're to compute the after bonus, if you remember, we are gonna divided by 100% plus 20%, which is the bonus. So that is 120%, and then multiply by 20%. Okay, remember of this, ha? 36,000 divided by 1.2 times 0.2. So that is 36 divided by 1.2 times 0.2. That is how we're gonna solve the after bonus. Because class, if we are gonna solve before bonus, we are to simply multiply 36,000 times 20% directly. That is if before bonus. Now, since we are to compute for the after bonus, then we still have to divide 1.2% before we are gonna multiply the 20%. And so, with this method of computing bonus, we got a bonus of 6,000 pesos. So, class, if you're gonna check, okay, we have net income. We have net income of 51,000 less salaries of 15,000. Now less bonus of 6,000. So this is already the net income after salaries and bonus, right? So that is 51,000 minus 15 minus 6, that is 30,000. So if you're gonna multiply that one by 20%, multiplied by 20%, so 30,000 times 20%, we can get 6,000. Okay, so here is the computation for the 6,000 after bonus. Alright, but take note class, if you're gonna compute the after bonus based on net income after bonus using this method which I highlighted, you cannot compute it because you're still to compute for the bonus to get the bonus. Okay, that's why we have this method of dividing it by 120% multiplied by 20%. Now, where did we get the 120%? Take note, 100% is fixed. Okay, plus the bonus rate. So whatever is the bonus rate, you have to add it to the 100%. Now for the bonus class, for PP, that is 6,000 pesos. Now accordingly, any remainder is to be allocated based on a 30-70 ratio. Okay, now let us compute for the remainder. Now since we have a net income of 51,000. So how much is the remainder in this case? So we have 50,000 minus 15 minus 12,500 minus 6,000, that is 17,500. For PP, he has a share of 30%. So 17,500 times 30%. And for QQ, he has a share of 70%. So 17,500 times 70%, that is 12 to 15. Now to sum up, okay, for PP, we have 26,250, and for QQ, we have 24,750. And as you can see, that is in letter dog. Okay, that is letter D. Alright, illustration 2 is letter D, PP 26 to 50 and QQ 24,750. So I just hope that you understood my discussion. Okay? Now next, let's proceed. Alright, financial statement for a partnership. Now, in a financial statement for a partnership, just like a sole proprietorship, it has the statement of comprehensive income, statement of changes in partners' equity, statement of cash flows, and all other financial statements that is needed for the business or for the company. Now, in the statement of comprehensive income, okay, so actually, it's just the same. Sales minus cost of sales minus expenses, add the other comprehensive income. But in the case of partnership, explanations of the division of net income among the partners may be included in the partnership's statement of comprehensive income. So, you may disclose there how is the profit being distributed, or you may also disclose the computation of the profit. But take note, it is not required, okay? But you may include it so that those who look at the financial statements will understand. Okay, why is the capital like this one? Why is the profit of PP higher or lower than QQ? Or why is the profit of the one partner higher or lower than the other partner? Then they will understand. Okay, so that is just the difference between the partnership and sole proprietorship, because in sole proprietorship, okay, we don't have to allocate the profit because all profits of the business will all be credited to the sole proprietor's capital account because he's the only one who owns the business. Now for letter B, statement of changes in partner's equity. The purpose of this statement is to present the details that cannot be readily incorporated in the statement of financial position. Now class, in a financial position, you have there the partner's equity accounts in which we can see that there is the equity of partner 1 and partner 2. There's also the withdrawal account of partner 1 and partner 2. But take note that a statement of financial position, the components of those equity are not being broken down. So that's why we have this statement of changes in partners' equity so that we can see how did we come up with the ending balance of our equity. So in a statement of changes in partners' equity, we can see there the beginning balance at the beginning of the year, the balance at the beginning of the year, plus any additional investments that is made by the partner, and then minus any permanent withdrawals that is withdrawn by the partner. Now we can also see there their share in the profit or loss of the partnership. Okay, so the statement of changes in partners' equity is just the breakdown of how did we get the ending balance of the partner's equity. Okay, so this is also important, especially if, let's say, of course, in a not all business or not all business owners know how to make financial statements. So they need accountants or bookkeepers to compile their financial statements or to make a summary of their financial statements. Now, of course, there are those partners who are only capitalist partners and who are not really active in the business. So how are they going to know if what happened to their capital? So that is why we have this breakdown, right? We have the statement of changes in partners' equity to see what are the amounts that affected the equity balances of these partners. Okay, and lastly, we have the statement of cash flows. I know we already know about this. It is the breakdown of all the inflows and outflows of cash in the business, and it is being grouped according to their nature. So whether the cash is used in the operating activities, whether the cash is used in the investing activities, or the um, financing activities. So that is the statement of cash flows. Now, changes in the profit and loss ratio. Partners may agree to change their profit and loss ratio. When changes in the profit and loss ratio occur, several problems will be encountered in the determination of partners' interest, among which are the following. There may be difference between the book value and the fair value of tangible assets. The partnership might have intangibles such as goodwill that are not recorded in the books but which must be considered in determining determining the fair value of the partner's interest. The partnership might have kept its books on a cash basis, and as a result, there may be unrecorded assets and liabilities. These too must be considered. After considering the above items, two approaches can be used for a fair valuation of the partner's interest as follows. First, adjust all assets and liabilities to reflect their fair values. Also, record any unrecorded assets or liabilities, if any. This should be made to the partner's capital account in accordance with their old profit and loss ratio. Calculate the effects of all the differences between the book values and fair values as well as the unrecorded assets and liabilities, and adjust only the partner's capital account for the net effect of these adjustments using the old profit and loss ratio. Under this approach, no adjustments of assets and liabilities are recorded in the books of the partnership. So plus this is in the case where there is a change in the profit and loss ratio. So profit and loss ratio, that is how they are to distribute their profit or loss of the business. So let's say the profit and loss ratio before was 50% and 50%, but the partners decided to change it to 50% and let's say 40% and 60%. So let's say for example, class, um, the business has been operating for years, and for those years, the profit and loss of the partners or the profit and loss ratio of partner A and partner B is, let's say, 50% and 50%. So, let's say at the end of 2019, okay, this is their profit and loss ratio. So, of course, unless there are changes that will occur as to the profit and loss ratio, this profit and ratio will be the one that is to be used until the next years of the business. But it happened, class, that let's say, during June 2020, they decided to change their profit and loss ratio. So let's say, for example, for A, he's gonna have 40%, and for B, he's gonna have 60%. Now, what are we going to do in case there is a change in the profit and loss ratio? Now, accordingly, class, when there are changes in the profit and loss ratio, we are to um we are to update the partner's interest as of the date of June 2020. Okay? So instead of determining the what do we call this? Instead of determining their updated capital balances every end of the period, which is December 2020, okay, we are to update it on June 2020 because there is a change in the profit and loss ratio. Now, what we're gonna do is just to simply um consider any changes in the fair value and then adjust these ones to the capital accounts of the partners using the old profit and loss ratio. Okay, so that is since during June 2020, that is the date of change. So, the updated capital balance should be on May 31, 2020. So, by the time that the balance is already updated, then starting from June to December, okay, when we are gonna compute the profit from June to December, then we are gonna use the new profit and loss ratio. Okay, so for us not to be confused, because for the whole year of 2020, we have two P&L ratio, the 50-50 and the 40-60. So what are we gonna do is that on May 31, 2020, we must already adjust the capital account balances of the partners. Okay, so for if ever there are any profits up to May 31, 2020, we are gonna adjust that to the capital accounts of the partners for an amount of 50, or for the ratio, using the ratio of 50-50%. Okay, so on December 31, 2020, what are we gonna consider is not already from January 1, but from June 2020 And we are now to already use the new profit and loss ratio, which is the 40% and 60%. Okay, so that is how are we gonna compute. Alright, now adjust whether there are any changes in the fair value, and as you can see here, we have two types of method of how are we going to adjust to the fair value. So we can adjust all the assets and liabilities, and any credit or debit shall be made to the capital partner's capital account, or just simply calculate the effects of these differences, and then there will be no need for adjustments to the specific assets and liabilities, and then adjust it still to the partner's capital accounts. Alright? Now next, correction of partnership net income of prior period. So of course, there may be times that there are errors as to the computation of the net income from the prior periods. Thus, since there are errors as to the computation, let's say it could be that the income was understated or overstated. So, there is also an error as to the distribution of the profit and loss for the prior period. So, what are we going to do? Especially if usually these errors are already discovered after the, or let's say during the next year. Okay, so we're already done with distributing our profit, but we encountered or we discovered an error. Now, the partnership may discover errors made in computing depreciation, error in inventory valuation, and omission of accrued expenses. When these errors are discovered, the partner's capital accounts should be adjusted. The following procedures may be used. So, of course, class, those that those net income that we computed from the prior periods were already credited to the capital accounts of the partners. Now, since there are errors that were discovered, what are we going to adjust now is not the net income because it was already closed from the prior period, but rather we are to adjust their capital accounts because it is where we buried the net income. Now, what are the procedures? First, determine the correct net profit of the prior period. Then, compute the proper share of each partner using the profit and loss ratio in the year in which the error occurred. Compute the difference between the share in the profit that each partner actually received and the share would have received from letter B, and then adjust the partner's capital accounts by the amount of letter C. Okay, so again, we are to compute how much is really the correct profit from the prior period. After that, using that correct profit already, we are to compute for their share based on the profit and loss ratio in that year. Okay? And then, so after we have computed the profit and loss or the share in the profit and loss of the partners, we are to compare it with the profit that we computed before, which was wrong. Okay, so the profit that we have computed based on the wrong net income versus the profit that we have computed based on the correct net income. Now, any difference between the two will be adjusted to the partner's capital accounts. Okay? By what amount? By the difference between the two share in the profits. Now, let us answer illustration 4. For illustration 4, we have Pete and Rico share profits after the provision of annual salary allowances of 14,400 and 13,200 respectively in the ratio of 3:2. However, if partnership's net income is insufficient to provide for said allowances in full amount, the net income shall be divided equally between the partners. In 2013, the following errors were discovered. Depreciation for 2013 is understated by 2,100, and the inventory on December 31, 2013 is overstated by 11,400. The partnership net income for 2013 was reported to be 19,500. The capital accounts of the partners should be increased or decreased by. Okay, so class, for this matter, let us follow the procedures that I have just mentioned earlier. Okay, so first is to determine the correct net profit of the prior period. Okay, so we have here step 1, correct net profit. So first we have the unadjusted net income. So our unadjusted net income was 19,500 because accordingly, the partnership net income for 2013 was reported to be 19,500. Next is to compute for the proper share of each partners. Now, as you can see, we have here that there are errors that were discovered. So first we have the error in the depreciation. Okay, so accordingly, the depreciation was understated by 2,100. So if the depreciation was understated, that means that the net income was overstated. Okay, so meaning this 19,500 was overstated, so we have to deduct 2,100. In other words, we have to add depreciation. Okay, and next is for the inventory. So accordingly, the inventory is overstated by 11,400. So that also means that the net income was also overstated. Now, since the net income was overstated, we have to deduct 11,400. Okay? So, class, if you are confused, why is the net income overstated? So, take note of this one. Accordingly, the inventory end or the December 31 inventory was overstated. So if the inventory end will be overstated, what will happen to the cost of goods sold? That will be understated. So if the cost of goods sold will be understated, then what will happen to the net income? The net income will be overstated. Now, since the net income was overstated, we have to deduct our inventory. Okay? Now, that is for the adjustments. Then let us compute for the correct net profit. For the correct net profit, we have 19,500 minus 21 minus 11,400, that is 6,000 pesos. Alright, that is for step 1. Now, let's proceed to step 2. For step 2, compute the proper share of each partner using the profit and loss ratio in the year in which the error occurred. So, for this time, we are to compute for the share of the net income based on the adjusted net income. So we have here Pete and Rico. Now first, they are to be provided with salary allowances. Now the salary allowances is 14,400 and 13,200. So that is for a total of 14,400 plus 13,200, that is 27,600. Now any remainder shall be divided in the ratio 3:2. Okay, the remainder is 3:2. Okay. But class, our profit is only 6,000, right? That is only 6,000. Now, what is the rule? If the partnership's net income is insufficient to provide for said allowances in full amount, the net income shall be divided equally between the partners. Now, since our salary allowance is 27,600, but the net income is only 6,000, this means that it is not sufficient to be provided with salary allowances. So what are we gonna do is just to simply divide the net income, okay, equally. Okay, so to divide it equally, we have 3,000 for Pete and 3,000 for Rico. Okay, so class, this is our new share of the net income. 3,000 each. Because, again, accordingly, it is not sufficient for the salary allowances. So that's why we divided it equally. Okay, so if you're gonna ask, Mom, is that really the rule that if it is insufficient, then we have to divide it equally? Then no. Okay, again and again, in a partnership, we are to always make their agreement as our basis. Okay, the basis will always be their agreement. Whatever are their agreement, that is the one that we are going to compute. Now for this problem, the new share is 3,000 each. Now how about plus for the old share? Now since we are to compute for the new share and the old share, because we are to get their difference, then we also have to compute the old share. Now to compute the old share, let us see if the old share is sufficient for the salary allowances. So if you remember, the total of our salary allowances is 27,600. So how much was the old or unadjusted profit? That is 19,500. So still, it is not sufficient, right? It is not sufficient for the salary allowances. So what are we gonna do is just to simply divide it equally. So for the old share, they are still equal. Okay, so plus, for step 2, to compute the proper share of each partner, that is 3,000 each. Now let's proceed to step 3. This is where I'm gonna show to you the old share. Because in step 3, we are to compute the difference between the share in the profit that each actually received and the share each would have received from letter B. So we are to compare the new share and the old share. So how much is the new share? Accordingly, that is 3,000 each. And the old share is, since that is 19,500, we simply divide it by 2. So that is 9,750. Okay. So how much is the difference? So for Pete, the same, that is 6,750. And for Rico, the same still, that is 6,750. So what is the adjustment? Since the new share was only 3,000, while the old share was 9,750, then we have to deduct their capital account balances. Okay, so for step 4, adjust the partner's capital accounts by the amount in letter C. So we simply have to debit the accounts of both Pete and Rico by the amount of 6,750 and 6,750. Okay? So where are we gonna credit this one? So that would be from our accumulated depreciation and inventory. Okay? So, to make a journal entry, so that would be a debit to Pete capital of 6,750 and debit to Rico capital of still 6,750. Now, for the credit, we have, since the depreciation was understated, we have to add accumulated depreciation of 2,100. Okay. And for the inventory, since it was overstated, so we have to deduct the inventory. That means we have to credit it by 11,400. Now let us see if our journal entry is balanced. For the debit, we have 6,750 plus 6,750, that is 13,500. And for the credit, we have 21 plus 11,400, that is 13,500. So this is our journal entry. Okay, so that is for illustration 4. Okay. Let's proceed to illustration 5. What is the profit to be earned by the partnership before charge for interest, salary, and the balance, so that J will receive 40,000 pesos and the remainder of the profit after salary and interest? So as you can see, class, in this problem, we are to determine for the profit and not just to simply allocate their profit share. Because in this problem, what is given are, aside from the interest and salary, the remainder of J was already given. That is 40,000 pesos. So what are we gonna do? So, simple. We just have to make the table or the format for our profit distribution. So that would be for Mel and J and then the total. Then first, 10% interest are to be given to their capital investment. So let us start first with interest. So we have 200,000 multiplied by 10%, that is 20,000 pesos. And we have 120,000 multiplied by 10%, and that is 12,000 pesos. 20,000 plus 12,000, we have 12,000 plus 20,000, we have 32,000. For the salary, that is 36,000 to Mel alone. So we have 36,000 to Mel. And for the remainder, we have the 60 and 40 ratio. So that means that Mel will receive 60% of the remainder, while J will receive 40% of the remainder. Now class, to get the remainder, we are to first determine the profit. But since in this problem, the profit is unknown, but the remainder of J is already given, then we just have to work it back. Now, since the remainder to be received by J is 40,000 and his share in the remainder is also 40%, then we just have to divide 40,000 by 40% so we can get this, the 100%. Now, after that, we can already compute our profit. So, interest plus salary plus the needed remainder. So, our profit is 168,000 pesos, and that is letter A. Okay, now just to compute the table, I'm going to compute for Mel's remainder. That is 100,000 times 60%, which is 60,000. And to compute for the share of Mel, we have 116,000, and for J, we have 52,000. But what is just asked in the problem is only the profit, so that is letter A of 168,000. Okay, so that would be all for the part 2 of partnership operations, and that would be all for my discussion in partnership operations. So hopefully you understood whatever is discussed, and if not, you may ask in our video conference. And in case you have no internet connection to be able to attend the video conference, then just